Okay, let's start. Call the meeting to order. Linda, would you please call the roll to confirm attendance?
Yes, thank you, Chair Knox. The meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Green?
Present.
Mr. Santos?
Here.
Thank you. Mr. Kehoe?
I'm here.
Thank you. Ms. Greenwood?
I am here and caffeinated.
Thank you. Mr. Oakham?
Here.
Thank you. Mr. Bernstein?
Call me Liz.
Thank you. Mr. Kelly?
I'm here.
Thank you. Ms. Sanchez?
Here, not caffeinated.
Okay. Mr. Knox?
And not Liz.
And I am present as
And
well.
not Liz.
Okay. Staff participating in the meeting include the following: Chief Investment Officer John Grable, CEO Santos Cramen, Chief Counsel Stephen Rice, Principal Investment Officers Jude Perez and Vache Masarajian, Senior Investment Officer Chad Timko, Investment Officer Kwok Win, Interim Chief Financial Officer Ted Granger. Consultants participating in the meeting include James Walsh and Stephen Kennedy from Alborn, Jose Fernandez and Natalie Walker from Stepstone, Rob Coaches from the Townsend Group, Leo Festino, Stephen McCourt, Alina Wan, and Tim Filla from Makita Investment Group. And we have presenters Jorge Mina, Christopher Brady, Stella Condonicas from MSCI ESG Research LLC. Trustees, if you have a comment or question on any item, please use the Zoom chat option to be placed in the queue, or you may contact me directly. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
Thank you, Linda. Item 2 is approval of the minutes of the regular meeting of January 13th, 2021. Do I have a motion?
So move it.
I heard Mr. Green move, Mr. Bernstein is the second. Any comment? Okay, Linda, please call the roll.
Okay, Mr. Green,
Aye.
Mr. Santos,
Aye.
Mr. Kehoe,
Aye.
Ms. Greenwood, Ms. Green, thank you. Mr. Oakham,
Aye.
Mr. Bernstein,
Aye.
Mr. Kelly,
Yes.
okay, Ms. Sanchez,
Aye.
thank you. Chair Knox,
Aye.
okay, the motion passes unanimously.
Item 3, report on closed session items. Mr. Rice, is there anything to report?
Nothing to report, and as a reminder from the last meeting going forward, report outs of prior actions will appear on the written report out of today's actions that's posted on LACERA.com. Thank you.
Do we need to note that on the agenda going forward, or should I ask each time?
There may be occasions when I would want to say something, so I think we'll leave the agenda as is.
Thank you.
Thank you.
Item 4, public comment. Linda, I know you shared one written comment this morning via email.
Yes.
But we also have several requests to speak from the public. Can you please call on each of them in the order?
Yes, so we have received 7 requests from the public to address the board this morning. We will start off with Kelly Dixon. Ms. Dixon, you will have 3 minutes to address the board. Please enter *6 to unmute yourself. Ms. Dixon?
Yes, can you hear me?
Yes,
Yes,
we
we
can
can.
hear you, and you may begin now.
Good morning, everyone. Good morning, LACERA trustees. I'm sorry, my thing is on. Let me start over. Good morning, LACERA trustees and staff. My name is Kelly Dixon, and I'm a proud employee of the Los Angeles County Sheriff's Department. Like you, I was shocked and appalled at the attack on law enforcement and Congress at the U.S. Capitol last month. Please investigate any political ties between LACERA money managers and the groups behind the violence on January 6, 2021 in Washington, D.C. Thank you very much.
Thank you.
Thank you, Ms. Dixon. Next, we will call on Ms. Shadiha Carter. Ms. Carter, if you can just enter *6 to unmute yourself, and you will have 3 minutes to address the board. Ms. Carter? You
Yeah.
may begin now, and you will have 3 minutes to address the board.
Okay, thank you.
you.
Hello. Okay, ready? Hello, thank you and good morning to the LACERA trustees. I would like to thank you again and the entire LACERA staff for all the work that you do to direct our retirement funds. My name is Shahida Carter, and I have been an employee of Los Angeles County for 14 years with Child Support Services Department. Like all of you, I was shocked and dismayed by the attempt to overthrow the government on January the 6th. Please do all that you can to ensure that our retirement funds are not being used by entities directly or indirectly involved with the attack on the Capitol on January the 6th. Thank you again for your diligence on this matter and all other issues. You have all of my support.
Thank you.
Thank you, Ms. Carter. Next, we will bring in Dennis Green. Mr. Green, go ahead. You will have 3 minutes to address the board.
Okay, thank you.
Thank you. You can start now.
Okay, I'm bringing it up.
Okay.
Good morning, distinguished panel of trustees who proudly represent the retirement investments for Los Angeles County employees. My name is Dennis C.M. Green and have been a proud county employee with the Los Angeles County District Attorney's Office for 34 years. Embarrassing, humiliating, degrading, and outright deliberate desecration of the American democracy here in these United States on January the 6th, 2021. Most of the world sees America as a leading authority of practical application of maintaining a democratic society. January the 6th, 2021 will live in infamy as the day America failed. With the former president coupled with the catastrophe of January 6, 2021, we are officially the laughing stock of the world. If any funds in any form or capacity are being utilized for any company, organization, or entity for the purpose of such behavior as witnessed by the nation on January the 6th, 2021, should be held to the highest standards of the law and removed from the Board of Trustees immediately. Thank you.
Thank you, Mr. Green. Next, we will bring in Maribel Castillo. Ms. Castillo, you will have 3 minutes to address the board. You may begin now. Ms. Maribel Castillo, you may begin now.
Thank you. Can you hear me?
Yes, we can hear you.
Okay, excellent. Good morning, LACERA trustees and staff. Thank you for the work you do in directing our retirement funds. My name is Maribel Castillon. I have 18 years of active service as a public health nurse with Los Angeles County Children's Medical Services, and as of June 2020, I have been reassigned to serve on a COVID-19 nurse strike team for the Department of Public Health. I have also completed 2 deployments thus far to assist with COVID-19 vaccination distribution at one of the major centers. I have made myself available this morning to address the important topic of disclosure of political contributions by many managers to groups involved in the undermining of our democratic election results and our United States Constitution. We are currently living in remarkable times that require extraordinary, courageous, and mindful actions from people in power to move us into a more evolved and just democratic United States. The combination of increased transparency through corporate political disclosure and accountability is fundamental to properly manage risk and mitigate any unintended consequences at the portfolio level. I request the LACERA board stand in solidarity with the diverse membership of our retirement system to demand full accountability from any and all firms connected to the barbaric acts that took place in our nation's capital on January 6, 2021. I also request the LACERA board discuss the inclusion of criteria to investigate and monitor risk mitigation of this kind through the current or a new policy framework, and include these considerations in the hiring of future managers. Thank you.
Thank you very much.
Okay, next we will call on Keenan Sheedy. Good morning, Mr. Keenan Sheedy. If you could enter *6 to unmute yourself, and you will have 3 minutes to address the board, and you may begin now. Good, Mr. Sheedy, can you hear us?
Yes.
Okay, perfect. You can go ahead and start now, and you will have 3 minutes to address the board.
Do I do *6?
No, we can hear you. You can start.
Okay, thank you very much.
You're welcome.
Okay, thank you. Hello, LACERA trustees. Good morning. My name is Keenan Sheedy, and I retired from Los Angeles County after 46 years of service, and I worked in the Department of Health Services. And I'm very concerned about retirement security, as you can imagine. Favorable investment results are predicated on both a qualitative and a quantitative discussion of risk management. And political instability threatens the already tenuous growth of our economy and contributes to unpredictable market volatility. And anyone who's following the news can see this, as we have it proved before our eyes every day. Corporate responsibility is not a slogan, but is a critical goal and practice. Risk must be mitigated. And we have not only the right, but the responsibility to ensure that our retirement funds are not invested in corporations connected in any way to the attacks on the U.S. Capitol. So I request that the LACERA board discuss the inclusion of criteria to investigate and monitor risk management of this kind through the policy framework, and to include these considerations in the hiring of future managers. And I thank you for your time.
Thank you very much.
Thank you. Next, we will call on Ms. Carolyn Dasher. Ms. Dasher, you will have 3 minutes to address the board, and you may begin now.
Not only the right, but the responsibility.
Ms. Dasher, we can hear you.
Connected in any way to the attacks on the U.S. Capitol.
Ms. Dasher, you can go ahead and enter *6 to unmute yourself, and you may begin now.
Good morning, LACERA trustees and staff. I'm Carolyn Dasher, and I am a retired court reporter from LA Superior Court. Retirement community is important. Retirement security is important for us all. We have all seen how political instability threatens our economy and leads to an unpredictable market.
Ms. Dasher, can you hear?
And work for, yes?
Sorry, we lost you for a couple of seconds.
Oh, I'm sorry. I'll just start. If we give our money to managers or entities who fight against what we believe in and work for, it is not safe, it is not prudent, and it is not right. Thank you for your consideration.
Thank you very much. And I believe that concludes public comment, Linda?
Yes.
Okay, thank you.
Excuse me, Mr.
Mr.
Chair.
Rice, go ahead.
Did we also receive any written public comment?
We did. I mentioned at the outset that we received one that Linda distributed via email.
Very good. Thank you.
You're welcome. Item number 5, the Chief Executive Officer's report, Mr. Kryman.
Yes, Chair Knox, trustees, good morning, everyone.
Wanted to provide just some additional items for your thought. I wanted to make sure that I let you all know that the processing of the applications continues fast and furious. At the present time, we have about 1,400 applications that we received and are processing. In comparison to last year, we processed a total of 1,743 applications all the way through March Madness. And so it appears that we're on track to either hit that number again or more than likely exceed that number slightly. But we're bracing for a spike in the number of applications over the next 6 weeks. And so we will keep you informed of any new developments in terms of the workload, in terms of processing those particular applications. On Saturday, actually 2 Saturdays ago, we received a lot of inquiries over the phone. I think it had to do with the timing of the CEO's email messages to our members, that we had a pretty significant spike in the number of folks calling in on Saturday. This past Saturday, I'm not sure if it was the Super Bowl effect, but the number of calls that came in were not quite as great as it was the prior Saturday. But we have modified our ability to process and assist our benefits section on those Saturdays when individuals are not on the phones with our members. And so we're going to continue having the Saturday phone call center open and continue to move forward with answering our members' calls on Saturdays. So the other thing I wanted to make sure that you're aware is the recruitment for the chief deputy. That recruitment will close on February 16th. My understanding is that we have a really good number of qualified candidates that will be moving forward to the next phase. We're still, as I said, awaiting the final resumes to come in, and then we will report out a schedule in terms of when we anticipate bringing someone on board to fill that particular position. But my intent is still to fill the position sometime in March, like I mentioned before. So we're in the middle of our budget process, so we continue to meet with each one of the division managers so they can justify their requests. I can tell you that they have been very thoughtful in their submissions. We focused in on succession planning. We focused in on making sure that we have the resources we need to move forward on some of the IT initiatives that are greatly needed in order to be more efficient moving forward. And then the final area that I wanted to mention was actually that was the final. That's the final issue that I wanted to bring up. I know that there's a pretty long meeting, and so with that, I'd be more than happy to answer any questions.
I believe Mr. Kelly is in the queue with a question or comment.
Yeah, thank you. Thank you, Santos. I just wanted to ask if you could include in your written report the status of all executive recruitments, not just chief deputy, but I think there are other assistant directors as well. That was it.
Yeah, we haven't started the executive recruitment on the AEO yet. We're waiting for the chief deputy to come on board because I'd like that individual's experience to assist with the development of the job descriptions and be part of that process. We have some mid-level managers that we're moving forward on our administrative services side of the shop, which are critical positions. They're the budget side and the risk management side of the shop. And so I can certainly provide you with an update on where we are with those particular items as well.
That'd be great. Thank you.
I did just look at my notes. The one thing that I did want to mention, Trustee Kelly had asked about how we categorize our members in terms of active members, retired members. I can tell you that after we read through the CAFR, I asked our IT section to go ahead and take a look at how we categorize them. There are a couple of issues that we have to investigate. So for example, it's not real clear how we categorize an individual that is on a deferred retirement, that is not eligible for retirement because they don't have the number of years. But once they reach 70 years old, they may receive a benefit. And so there's a couple of areas that we really need to take a look at and try to determine how we're going to count them. And so we're going to go ahead and do a complete look at all of the categories that we have. And so there may be a change in the number of active member, not active members, but the number of members total. And how do we count survivors, for example? Are they really members? Are they technically not members? How are we going to count them? So that's one of the things that was the last thing I wanted to mention to you all as well.
Thank you. Thank you.
Okay, I have Mr. Santos in the queue.
Thank you, Mr. Chair, and thank you, Mr. Kryman, for your report. Two questions. One, what's the status for the performance evaluation for the CIO and General Counsel? And also, I understand that several county departments, my department included, public defenders has requested assistance in trying to identify 120 candidates. If you can provide us an update on the status of that. Thank you.
Sure. In terms of the 120 candidates, we did receive some inquiries from the public defender's office. We have assisted them, told them that we do have the ability to reach out to our retired members, and we have the ability to isolate the public defender attorneys is what they're looking for. We did offer assistance to do a mailing, which is consistent with what we've done in the past. In order to get the 120-day folks, we would direct them to the public defender's office so that they can process the 120 days. I know that the public defender at this particular point in time is working with the CEO's office, so they have not completely solidified the program that they wanted to implement, and so we're on hold with that. And so to the extent that our plan sponsor requests some assistance in terms of mailings or providing notification to our members, we'd be more than happy to assist with that. It'll have to go pursuant to whatever policies we have in place, and we will follow that policy. So thank you for the question. In terms of the CEO's office and general counsel, I did not speak to Carly about that this morning. So I'm going to have to get back to you on that. I don't want to give you any information that I may have to retract. So I know that that her intention was to get everything to you all by March at the latest. So there should be an item either at the a joint meeting at the end of the month. I believe we have one, or I believe it's in March, actually, the joint meeting. So that's the status on that.
Mr. Knox, I have a follow-up question, if I may. And this also goes, perhaps this question is not to you, Mr. Kryman, but I guess it's Steve Rice or Dr. Montoya, whoever, but also I will encourage staff to work diligently in getting and finalizing the performance evaluation for the CEO, and hopefully that issue will be placed on the agenda for the next joint meeting. I had requested that previously, and I would like to again request that we get through the process as soon as we can. Thank you.
Yes, Trustee Santos and trustees, Dr. Montoya is working on that issue. She is finishing the collection of the information, the analysis of the information, and coordination with the board chairs to bring that back to the boards for action, and that would be an open session item.
Thank you, Steve.
Okay, thank you. Unless there are any other questions, we're moving on now to item 6, the Chief Investment Officer's report. Mr. Grable.
Good morning, Mr. Chair and trustees. And I will stall for a second and thank Chris Wagner for driving all the slides today. And Chris, thank you. And first, I thought that was a fantastic corporate governance committee meeting. So thank you Chair Bernstein, and thank you, Scott, for arranging the speaker. That was absolutely fantastic. So, Chris, if you can turn to slide number 4, please. Okay, thank you. If we look at these charts, it appears that we are in the best market ever. The equity markets are at an all-time high. As we see in the upper left, the global equity market represented by the ACWI IMI is up 15.8% for the last 12 months through January 31. If we go over to the upper right, the Russell 3000, which is the US equity market, it's our benchmark, is up an astounding 20.5% over the last 12 months. And in the bottom left, the MSCI Emerging Market Index is up a ridiculous, about 24%, once again, over the last 12 months. Risk assets are clearly explosive. Ms. Sanchez raised this theme during the Corporate Governance Committee, and it really is driven by low historical interest rates that we can see on the next slide on the upper right. Thank you, Chris. Going from the prior slide where I made a statement that this is maybe the best of times for the markets, this slide maybe identifies somewhat of a Dickensian duality. Whereas the prior slide was the best of times, this slide says otherwise. And the worst of times may be represented by the contraction in global domestic product, GDP, which is in the upper left-hand box. There is a huge economic toll from the pandemic. And we see that major economies were negative in 2020. The slide also shows in the bottom left that equity valuations are at elevated levels. Massive global monetary and fiscal stimulus has pushed capital to take excessive risks. And this works as long as GDP grows faster than the cost of capital or borrowings. And one way for us to think about this is that there's a huge generational credit card that we're spending right now. And it's important to remember that there may be no alternative to this stimulus, but what it means for our long-term portfolios and how we allocate capital really is something that we need to think about as we continue our strategic asset allocation exercise. Going to the next slide, unemployment on the top right looks much improved. Yet it's important to recall and remember that the data is very noisy. We're clearly much better off than we were last spring when unemployment topped 14%. Currently, it's about 6.3%. However, underemployment rates still are in double digits. And part of that is because fewer people are seeking jobs. And in another sense, the granularity of these numbers is lost in averages and broad measures. And for example, the quality of jobs, and there's a huge difference between full employment, which is a macro measure, and being fully employed, which is more of a micro measure. And it's such a stark difference between the number of people that are employed and those that are fully employed. And these variations exist by geographic regions in the country, demographics, and different industrial segments. Turning to the next slide. And here I'll reinvoke Dickens for a moment, and maybe the age of foolishness is too easy not to mention on the left-hand side, where we mentioned kind of the GameStop Reddit frenzy or the digital boiler room. And maybe the bubble here, it's important to flag it because it's an important issue for us as an institutional investor. And it's less about our exposure or direct exposure to GameStop or AMC. We're not in the hedge funds that were in the news for closing. It's important to us because of the back office and trading infrastructure or plumbing, which is a word that Mr. Fleming used. This is a consistent theme that we've discussed. We've discussed operational due diligence and the importance of middle and back office capabilities. And one other area that we should discuss, and maybe the right place to discuss this is with the equity committee, is to talk about trade execution and clearing. And we'll do some type of analysis, maybe bring in a speaker to talk about the importance of trade execution and clearing. If we can go to slide 9. Slide 9 shows our results through the end of 2020. The pension was up 2.4% net for the month. The balance was 65.4 billion. On the right-hand side, it shows that we're within targets for all asset categories, with our largest overweight of about 3% to public equity. This certainly helped us from a returns perspective in a year in which equities had double-digit returns. And it also shows that our largest underweight was to investment-grade bonds. We're about 150 basis points or 1.5% underweight. And absent 6 weeks towards the end of Q1 2020, it was a risk-on market fueled by the massive monetary and fiscal stimulus. Slide 10. For the year of 2020, the pension was up 10.1%. The headline number may not be as high as some peers. Many of our peers have more than 50% allocations to global equity compared to our 35% target. Those plans do have much higher volatility than we have, or maybe one way to say that differently is that we embrace diversification. That's one of our investment beliefs. We all know that the future is uncertain and hindsight investing is maybe too easy. And this number is not on the page, but this is something that we'll discuss later on during the meeting, where we have a speaker from MSCI to talk about our risk platform. The fund's annualized volatility in 2020 was 12.5%, and that's in the best decile. So the quality of returns is really important to us as a plan that is cash flow negative, a plan that is mature. Going to OPEB, the balance is getting very, very close to $2 billion. The plans were up 3.4% for the month, or close to 17% fiscal year to date. OPEB has a different asset allocation and implementation methodology than the pension. OPEB is more passive and has greater liquidity than the pension. The results are materially higher volatility and a lower Sharpe ratio. And once again, the Sharpe ratio are returns per unit of risk. One other thing that we don't talk about is that there are different time periods that we measure when we compare, say, a one-year return for the pension and OPEB, in that certain asset categories like private real estate or private equity are reported with a 3-month lag, which means that certain portfolios may only have 9 months in common. So there's a difference in reporting periods that really are masked within the numbers. Later on, Makita will talk about the potential use of alternatives in our OPEB portfolio. Now that the size is nearing $2 billion, it may be an interesting opportunity for us to think about expanding the implementation methodology and how we choose to gain exposure. Turning to slide 17, and this will be the last slide that I discuss, which is the staff chart of the month. This chart, or these charts, look at global GDP growth, and it's clear really on both sides that the 80s and the 90s were more about the North Atlantic region of the globe, and GDP growth in the aughts plus really are about China and emerging markets. And I'll use this chart and I'll see if it works. If not, I apologize, to pivot to a question that trustees have asked about succession planning. And this is how I'll try to pivot. The countries on this chart need to recognize that there's a changing nature of global commerce and where the marginal growth may come, and that may be economic succession planning. For us in the investment office, we're focused on more traditional succession planning. We've created functional teams, much like we have a functional asset allocation. We have many more internal investment committees that really look to encourage more voices, to have a sense of internal equity and get everyone involved. We hope this builds a deeper team, one with much more balance, and one that best positions LACERA for the years that aren't even on the far right of this chart, but are well beyond the far right and are yet to come. So with that, Mr. Chair, I'm happy to stand for questions.
Thank you. I have Ms. Sanchez in the queue.
Hi, good morning, Mr. Grable. So I love your Dickensian allusion, by the way, it was lovely. So I think, you know, one of the reasons that it's the best of times in the market and the worst of times in economic reality is that the markets are pricing COVID as a temporary phenomenon and therefore have not adjusted to that, assuming that we will get over this. But I saw two pieces that gave me cause for concern, and I wonder if you can opine on your thinking about these risks. The first was a piece from Bloomberg basically suggesting that at the current vaccination rate globally, we should achieve herd immunity in 7.5 years, which I don't think is priced into the markets and could portend sort of continued travel restrictions, et cetera. And the second article was Wall Street Journal article 2 days ago, basically suggesting that the speed of mutations of COVID and the new variants, there are scientists that are legitimately arguing that COVID may be here to stay and that we may have to learn to live with COVID. I don't think either one of those is priced into the markets. And so tell me, I would love to hear your sort of stream of consciousness on kind of what kind of risk that presents to the current valuation.
Sure, and I read both articles and I'll comment on them together and separately. And I'll bring up another interesting article that was in today's Wall Street Journal about polio and how the eradication has been slowed down dramatically as a result of COVID. And I think that they cite Pakistan and some countries in Africa, you know, and maybe this is personal, but, you know, I recall stories from my parents who grew up dealing with polio, and it's still with us. And I think that it will be with us for a long, long time. The other aspect is weaving in the thread that the pandemic is now endemic, is that, you know, flu, we still deal with flu, and we get, you know, vaccines, or many of us get vaccines on an annual basis, and doesn't prevent the flu. Maybe it helps mitigate the worst case aspect of it. But for one, and this may be my personal belief, is I believe that masks are with us for a long, 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 long time. I think that in my briefcase for the rest of my career, which hopefully is for a long time, I will always have multiple masks, and depending upon the setting, I will have to wear the mask. So I agree that the markets are reacting to a sugar high. The sugar high is a result of this massive liquidity, global, from monetary and fiscal authorities. There's no choice, maybe, or no alternative. But I think that the global markets, the nature of commerce, and the types of businesses that thrive may accelerate and be changed forever as a result, or at least for the next decade plus, as a result of changing consumer consumption patterns, travel behaviors, you know, things like migration patterns may change, demographics may change in terms of growth trajectories. So I think that this is really with us for the long term. And maybe the last thing, and then I'll come up for air, is we as a society really like easy. Easy is we're gonna get vaccinated and we'll be back to normal. Hard is, yeah, we'll get vaccinated, but this may, you know, mutate, and there may be variations that are with us for a long, long, long time. So what do? And hard is just hard for us. So I think that it's something that we just need to be cognizant of and recognize that things may be different, but we have to, you know, adjust accordingly.
Thank you.
Thank you. I have Mr. Santos in the queue, and then Mr. Bernstein. Mr. Santos?
Yes, thank you very much. I agree with you, Mr. Grable. We have to adjust, and you know, we as a society, we have been able to overcome many different obstacles, and this is just one of them. We will adjust, and we'll go forward. But what I really wanted to comment Mr. Grable and colleagues, is with regards to you key macro indicators and in particular the chart regarding the GDP growth. And as many of you have heard me in the past, I've been very skeptical with regards to investing in China, but can't help but to look at China's GDP in 2020 was 4.9, which tells me that while I am very nervous with investing in China, we have no choice because look at the growth of that economy that has been growing for years and years and years, and it seems to me that will continue to grow. So that's another adjustment that we have to make. That we have to deal with China and its economic power. That's happening by this chart, and so while we need to continue to be vigilant, we cannot stop investing in China. Thank you.
Thank you, Mr. Santos. Mr. Bernstein?
Thank you, Chair Knox. John, I just wanted to add some thoughts to the questions about the pandemic and the rat out. I think that our considerations are too binary, that we tend to look at the pandemic as being akin to a Will Smith alien invasion movie, and we are waiting for the alien spaceship to be blown up and then all the people go on the street and it's normal. I think the truth is that the experience in the 80s and the 90s of the AIDS epidemic is very relevant, that this is not going to go away. You're right. I think you're going to have a mask with you for a very long time, but I think it's going to become a much more chronic and livable situation. I think that as we look at the current thing, to me, the most profound thing going on is the extraordinary amount of stimulation that's been put into the markets and into the economy, both through tax revisions a few years ago and the stimulus packages. I think that's the real concern, but I'm not sure that optimism about COVID isn't priced in accurately, because while I don't think it's going away, I think that human beings have a remarkable capacity to normalize things, and that I think that we probably are not weeks away, but months away from a new normal emerging. So I thought your comments were great, and I do think that the massive amount of stimulation is clearly having the impact it's designed to have and the ripples that could be anticipated. But the market is incorrect in having some optimism that COVID's hideous impact is somewhat time limited.
Mr. Chair, can I make one comment?
Please.
And I'm going to bring this all back to strategic asset allocation. That's why I love the fact that we don't have all our eggs in one basket, because as we look to deploy capital and invest the retirement funds for the many LACERA members, both active and retired, is that I believe that we're best positioning it by truly embracing diversification and not just investing in what was hot last year.
Thank you, Mr. Grable. I have no other trustees in the queue. So thank you very much. We're now moving on to our non-consent items. Item 7, recommendation is submitted by Mr. Rice, Chief Counsel, to approve the powers and duties of Investments Board members, which will be included with the ballot materials for the 2021 election of the third member of the Board of Investments and posted on LACERA.com. There's a memo dated February 1st in the packet. Mr. Rice, any comments on the materials?
Yes, thank you, Chair Knox, and good morning again. This item is the annual review of the powers and duties of investment board members. The document has two uses. First of all, it's used in connection with the election that's going to take place this year for the third seat. It's provided to potential candidates, and voters in connection with the election. So it's an important document in that respect. And it's also posted on LACERA.com year-round and is a reference for members, the public, other stakeholders on an ongoing basis throughout the year on our website to see what the duties and responsibilities of trustees are. This year, we had the powers and duties reviewed by Fiduciary Council. Fiduciary Council proposed a number of important, but mostly stylistic and technical changes that are important for readability and accuracy. We also added a new section on trustee compensation, which has not previously been in this document, but is important for all the groups that I mentioned, whether it be candidates, voters, or members of the public and other stakeholders to be aware of with respect to trustees and the implications of their service. One correction that needs to be made in the section on compensation and expenses is the following. The document as submitted to you does include a reference to the withholding that is made for state and federal income tax. However, there is also withholding for a HIT, the health insurance tax, and so I request that that change be authorized in the board action on this item. Last week, the Board of Retirement considered its version of this document and made a few changes. 3 of them are relevant also to this board, and so I want to pass them along so that you can consider whether to include them in your version. The first relates to the introduction and the number of hours that is spent on board service. You should consider, as in past years, the continuing accuracy of that number, but the change that the Board of Retirement made in the introduction with respect to hours was to add a clause that simply acknowledges the fact that the number of hours spent by trustees in their work for the organization will be affected by the time spent in involvement activities, which is referenced again on page 3 in paragraph 11 of the document, and the same reference would also be included at that location. So two places to make that point. And then finally, in the compensation and expenses section, the Board of Retirement requested that FICA, the FICA implications be addressed, and there are 2 of them. One is that HIT, which is part of FICA, is not, it is withheld, but Social Security is not withheld. So with that, I would be happy to answer any questions. Thank you.
Thank you, Mr. Rice. I have Mr. Santos in the queue.
Just thank you for that, Mr. Rice. Yeah, that was my motion to approve this item with the suggested changes that you just mentioned, Mr. Rice. The bottom line is I want, in particular, the compensation and expenses to be consistent with what we adopted for the retirement fee, which is to split up that paragraph so make it clearer to the reader. So I move that this item be approved with the modifications stated by Mr. Rice.
Thank you. I have a motion to approve. Is there a second?
I'll second it.
Mr. Bernstein will second. Any further discussion or questions on this?
Chair Knox, just jumping off of Trustee Santos's comment with respect to compensation expenses, I neglected to mention it is accurate that part of the changes that would be made here would be to break the compensation and expenses section up into 3 paragraphs for readability.
Okay, I assume that's acceptable to Mr. Santos and Mr. Bernstein.
That's what I was referring to in my earlier comments. So yes.
We were there last week, so I understood it that way too.
Thank you. Any other questions or comments on this item? Okay, Linda, please call the roll.
Sure. Mr. Green?
Aye.
Thank you. Mr. Santos?
Aye.
Mr. Kehoe?
Aye.
Ms. Greenwood,
Aye.
Mr. Oakham,
Aye.
Mr. Bernstein,
Aye.
Mr. Kelly,
Yes.
Ms. Sanchez,
Aye.
Chair Knox.
Aye.
Perfect. The motion passes unanimously.
Thank you very much. We are on to item 8, reports. Item A, strategic asset allocation, capital market assumptions, and OPEB master trust discussion. Mr. Perez, would you like to lead us off?
Yes, good morning, Chair Knox and trustees. As you mentioned, the next item on the agenda continues our monthly discussion on the strategic asset allocation study. For this month, while the strategic allocation is one agenda item, we will have 2 separate discussion topics. The first topic will cover capital market assumptions and the process that Makita has undertaken with staff and the other asset category consultants to help derive a set of assumptions that may be used in the asset allocation study. As we discussed last month, the capital market assumptions are fundamental inputs in an allocation study, and it is our goal that a set of assumptions will be brought forward to the board for a recommendation in March. In the second part of the presentation, Makita will discuss the OPEB Master Trust, as John Grable mentioned in his CIO report. Makita will highlight the different asset classes between the OPEB and the pension plan to help facilitate a discussion on possibly incorporating e-liquid investments into the OPEB strategic asset allocation, which to this point has only been invested mostly in passive strategies. So with that background, I'll hand it over to Leandro Festino, Tim Filla, and Alina Yuan from the Makita Investment Group.
Great, thank you very much, Jude. Thank you, Mr. Chair, members of the board. We're here to just go over a little bit of the ongoing process that we've had on working on the strategic asset allocation, and in this particular context, the development of the capital markets assumptions. Chris, could you advance the slide? Excellent. So in September and October, we brought forth a couple of items. One was an interim set of capital markets assumptions that were based off of the sharp decline in interest rates that were experienced over the beginning half of this year, and also incorporated some updates on risk asset valuations. And we also brought forth a piece that was tied to that about strategies for investing in a low interest rate environment. Following that, we had some conversations with staff and also with your other asset category consultants, just to kind of vet the ideas that were put forth there, see how that may ultimately play into the strategic asset allocation, and then also certain implementation decisions that we'll be making following that. So this is really just an update on the work that we've done. We also think this is really important work because of the timing of when our capital markets assumptions are being presented. Those were just recently published, and we're looking to review those with the board at the next meeting. So we really wanted to get a lot of this work done in the background so that you were looking at a set of assumptions that wasn't going to be subject to any additional revisions or debate. And given that we're also trying to complete the strategic asset allocation for to be set up for another new plan year. Chris, could you advance to the next one? So here are a couple of the categories that we had some conversations. We met with Stepstone, had a couple of phone calls, and ultimately our interim capital markets expectations don't go through the same vetting process that our full year capital markets assumptions do, where it goes through multiple internal committees at Makita. Ultimately, the issues that Stepstone raised with our interim assumptions were resolved largely when we published the new fully updated ones. The most notable item was a somewhat lower premium return for private market assets over equities, which was at 1%, and that's now increased to about 2.5%. We also had venture capital slightly trailing the expectation for buyouts. That's also been resolved in the fully published estimates. Can we skip to the next category? So for real estate, we had conversation with Townsend. We had some fairly substantial differences off of the interim market assumptions. Some of those also resolved as the year developed. As an example, Townsend had a range of 5.5 to 6% for core real estate. We were originally at 4.7%, and that was raised to 5%. On a 10-year basis and 5.5 on a 20-year basis. We all agree that that was reasonably within the wheelhouse. And ultimately, the approach came down to what we consider implementation decisions. They take a somewhat more tactical view on their capital markets expectations and look at it from the context of deploying the next dollar in your program, whereas Makita's looking at it from a very long-term perspective, not trying to account for the exact positioning we're at in an economic cycle. So ultimately, that accounted for the differences there. We could move forward to credit and a liquid credit. Here with Alborn, we were very close with them across the board on these categories. The one thing that did come up in conversations with staff and Alborn was the idea of perhaps reducing some of the granularity that's in this category for a functional category that has a relatively low weight in the portfolio. It has an awful lot of line items associated with it. And we think ultimately that a lot of these come down to implementation decisions. So as an example, looking at what your overall allocation to private debt might be, that can change from time to time. Right now, we're in an environment where public market spreads are really, really tight, but there are still some attractive opportunities in private debt markets. So in allocating some additional dollars, that would be an implementation decision. And so we just think having a little bit of flexibility there within the category might make some sense from both a strategic and a tactical perspective. On the next page, natural resources, commodities, and infrastructure. Again, we were all very closely aligned here, so nothing major to report on this category. And then lastly, we'll just talk about hedge funds briefly. So here there were some significant differences between Alborn's expectations and Makita's. We each have assumptions for a lot of granular asset categories within broad hedge funds. So Makita models 8 or 9 different hedge fund strategies, all within the hedge fund group, and then roll that up into a composite. If you recall from the last go round when we did the strategic asset allocation, we ultimately ended up creating a custom composite for use in modeling because, again, the shape of LACERA's program was somewhat different than Makita's composite. And we also thought it was quite noisy to use lots of different line items within what's ultimately a 4 or 5% allocation at the total fund level. So here again with Alborn, we came up with what we think works well as a custom composite that reflects how they're thinking and how staff is thinking about positioning the hedge fund portfolio overall. So more as a defensive risk mitigating as opposed to an alpha seeking hedge fund type program. So we all ultimately got on the same page. We're still running how that's going to look on a correlation basis, but we think we're in the neighborhood on finalizing that. So with that, we have a couple of items overall to consider, and I think whether or not we want to have the credit group consolidated somewhat, I think is going to be an important decision. I think also possibly looking with the changing landscape, whether value add real estate really fits better in with the profile of the growth category overall. TIPS is always an interesting one because it really is a dual purpose type of asset. It clearly has inflation hedging properties, but it also is really correlated to investment grade fixed income returns and can play a defensive role in the portfolio as well. And then lastly, we think we should be looking as we go forward into this exercise. LACERA's portfolio has become more complicated and has additional layers to it, such as some of the overlays and various different types of hedges. And we think it might be worth consideration to create a 5th functional category where those all live to help clean up some reporting items and otherwise just evaluate risks within the portfolio going forward. So with that, I'll stand for any questions on the process that we went through. These next steps are actually included with the next presentation as well. So I will let Leo and Alina handle the next steps portion of it.
Are there any questions right now before we move forward?
Yeah, I have a question, Keith.
Sure. Mr. Oakham, go ahead.
Yeah, just wondering, a very good presentation. I think it gives us a good, what I really like about the presentation is you put the volatility in there, which is interesting to look at with the returns. But at this time, and I don't know if this question should be answered by, real estate is really low. Are we going to take a look at making some investments, if we can really bottom fish good quality products that are out there where people are having problems making payments, and we could pick up some great properties? I don't know what the answer to that question is, and it's something we're going to look at.
Mr. Chair, can I answer?
Please, go ahead, Mr. Grable.
Thank you, Mr. Chair. Thank you, Mr. Oakham. The way I would suggest we proceed with a question like that is to divorce the asset allocation discussion from the implementation discussion. And we do structure reviews of all the different asset categories periodically. And that's the type of discussion for the Real Assets Committee to have as to how best to deploy what is allocated at the macro level within real estate.
Thank you, John.
Thank you, Mr. Grable. Any other questions before we move on? Seeing none, hearing none. Okay, let's move on to OPEB.
Thank you, and good morning, Mr. Chair, trustees, and members of the public and staff. As CIO John Grable mentioned, the OPEB has increased in assets substantially from the last time we conducted an asset allocation study, getting close to $2 billion. The last time the board approved an asset allocation for the OPEB was in December of 2017. So we're back at it again after about 3 years. And as the first bullet states, it's always important to keep in mind the reason why, and that is because the asset allocation is expected to be the primary determinant of the fund's risk and return outcomes. So what we're going to start in this brief presentation is by comparing and contrasting the two asset allocations. And then we're going to go into each one of those, I guess, ultimately trying to determine if adding additional asset classes such as private equity, real estate, illiquid credit, etc., makes sense or not. We think that they make sense, but there's considerations to take into it. Keep in mind, all of these assets are there to meet a certain liability stream, so it's important to look at that piece of the equation as well. On the next slide, please, thank you. We evaluate the current policy for the OPEB, and you'll notice it's not identical to the pension fund, but it rhymes, it's similar. It has half of it allocated to growth, and then 20% to credit and real assets and inflation hedges each, and 10% to risk reduction and mitigation. It's much simpler, it's primarily managed with passive index strategies. Using the most recent projections, we estimate the midpoint of the return of distributions over a 20-year horizon to generate a return stream of about 5.3% with volatility around 13%. To put things in perspective, this is about 100 basis points lower than the OPEB target was at the time of the last asset allocation study. It is not surprised, this has been fairly common in the industry now for a decade or two, that adding asset classes that are less than perfectly correlated, that may generate excess return over the traditional asset classes such as stock and bonds, may add value from an optimizer standpoint and ultimately from an actual realization of returns. And so as you add private equity, real estate, and illiquid credit, you observe, generally speaking, an increase in the expected returns, but they tend to come with risk that doesn't change that much dramatically because they are less than perfectly correlated. Ultimately, that means the portfolios are more efficient as evidenced by Sharpe ratios that are higher than the current target, current policy target. On the next slide, slide number 4, we compare and contrast both funds. On the left is the OPEB, it is simplistic, and the real estate, for example, that is just with REITs, which trade in the open market much like stocks do, and that's a full 10%. It's a lot more volatile, as John Grable mentioned earlier today. On the right-hand side is the defined benefit fund. It has more asset categories. It includes private equity, real estate under different categories such as opportunistic and core and value add. It includes infrastructure. It includes illiquid credit. It includes hedge fund. So it might be too much to do all of these at once, but at least some of those might make sense. So the purpose of this meeting is to generate a dialogue and to get perspective from the trustees on the receptiveness on the reception of these ideas. My colleague Alina will now go over these potential new categories one by one, starting on slide 5.
Thank you, Leo. Good morning, Chair and trustees. Good to be here with you all today. I will review some of the potential additions to consider, starting with growth. The growth assets generally represent equity or equity-like interests and future income streams. And so currently growth for OPEB is entirely passive public equity. So it would make sense to consider private equity in the OPEB functional category in order to take advantage of active management in the less efficient market segments. Private equity is a compelling asset class to add for a number of different reasons. It has higher expected returns. There's apparent price volatility is lower, and interim return correlation to public equity is subdued. In addition, there are just a lot more private equity companies or private companies than there are public, so the investable universe is quite large. Implementation of a private equity program would take a number of years, and there's a number of different ways to start the program. One consideration is secondaries or buying existing investor commitments. You could also consider using all or some of the pension fund commitments that the pension fund is currently invested in to build that program over time, and also looking at multi-manager investors such as fund of funds to gain diversification early on. Next slide, please. Next is credit. The credit category is expected to have moderate risk compared to growth, and its role is really to produce current income as stated by the investment policy statement. One consideration for credit is to consider adding illiquid credit. And currently illiquid credit represents 25% of the pensions credit category. Illiquid credit generates return from illiquidity and credit risk, and typically what is lost in liquidity can be gained in higher risk-adjusted returns. As with private equity, some of the ways to implement an illiquid credit program would be including fund of funds, secondaries, and also pairing up with additional commitments or current commitments that the pension fund already makes. Next slide, please. Thank you. Next would be real assets and inflation hedges. And again, the role of this category is to provide income as well as serve as an inflation hedge. And so the pension currently has a 7% allocation to core and value added real estate within real assets and inflation hedges. And that actually makes up about 41% of this, the real assets and inflation hedges bucket. So adding private real estate can have diversification benefits because real estate has lower correlation of returns between other asset classes. Currently, the OPEB has a REITs position, and the REITs position could be replaced or complemented with a private real estate allocation. Again, similar methods of implementation here with considering secondaries, fund of funds, or pairing up with current commitments of the pension plan. Next slide, please. And finally, I'll walk through, I'll summarize some of the highlights from the OPEB presentation today. We're having this conversation today because the OPEB Trust has grown into a very large investment portfolio nearing $2 billion and warrants consideration for adopting an asset allocation that includes private assets, just like those defined in the pension plan. Some things to consider would be asking yourself, will introducing private assets be appropriate for OPEB, especially if it introduces liquidity risk in the short term? And then you want to understand what the anticipated liquidity profile of the OPEB trust is in the future to ensure that these illiquid assets would be an appropriate addition. Also, I would stress understanding all of the actuarial aspects of the trust, including funded status, for example, and how that should be a part of this evaluation process. Finally, in terms of understanding that private market opportunities will require greater attention and allocation of resources, whether that be through legal or staff, et cetera. It will require more resources than the OPEB's current, mostly passive strategy. So today's presentation, I'll reiterate, is really an introduction to the gradual steps into introducing some private asset classes into OPEB. Next slide, please. And finally, in terms of next steps, in the coming months, we'll be reviewing and approving our final capital market expectations, and we will be presenting any possible iterations for both OPEB and the pension funds, and ultimately adopt a strategic asset allocation for pension and OPEB towards the later half of this year. And with that, we'll stand for questions.
Thank you very much for the presentation. I have a couple of trustees in the queue. Mr. Santos.
Great, thank you very much for that presentation. So I'm in favor of adding asset classes, additional asset classes to the OPEB, in particular private equity and real estate and others. But so my question to you is, and I guess to Mr. Grable, is are we going to have a discussion in the near future regarding how we're going to go forward into these new asset classes? So just taking private equity as an example, are we going to have a discussion regarding is the best way to go through the secondary market? Do we want to piggyback to some of the current investments that we have in the defined benefit program? The details of how it will be the best way to begin investing in these additional asset classes.
Thank you for the question, Mr. Santos. I think it's a really important discussion. One being the liquidity, the needs for liquidity are different. Second, the sophistication is the wrong word, but the existence. The pension's been investing in these asset categories and has moved, beyond that core that's been built over decades to adding highly specialized positions across different asset categories. And then the third consideration just is resources amongst the investment team, because we don't have a dedicated OPEB investment team. So I think one of the things for the board to consider, should a decision be made to include illiquid assets and private assets, is to think about, maybe to start with a kind of maybe a master account or an RFP to do a multi-asset mandate where we can identify what the parameters are, what the asset categories are, and just see what type of portfolio a third party can help us build. Do everything in our name such that over time we can add more specialized positions to it. But I think that there are multiple aspects to that question.
So you're talking about fund of funds? Is that what you're referring to as a potential, or what does that mean?
Yes, I think we use the word fund of funds loosely. When we use fund of funds, it's mostly in our name, and it's not that we're committing to a fund that invests in a commingled vehicle alongside other parties. This is something that we could potentially do in our name with a single manager or just a small number of managers, as opposed to having in private equity, for example, 15 commitments a year, because the bite sizes would be really small for the OPEB trust, and it may be very difficult to implement that.
It appears to me, really quickly, it appears to me that co-investing will be an ideal, but that's to be discussed and flush out. Thank you.
Thank you, Mr. Santos. Mr. Kelly?
Thank you. I had a few. First, I'm so happy that the trust fund is $2 billion, because I remember when it was first established, I think of $400 or $500 million, so it's pretty significant. This issue of liquidity, the OPEB trust we know is protected from creditors. It must be used for retiree health benefits. And there was another GASB requirement as well that we met with the trust. The contribution is irrevocable. So what is the concern about, what is the liquidity concern given those three characteristics that we know the trust fund meets?
And
the money's there. I mean, no one's coming in to take it. So what are the liquidity concerns? That's what I'm confused about.
Chair Knox, can I address that question?
Yes, please, Mr. Press.
Mr. Kelly, while they're irrevocable, some of the plans, such as Superior Court, they do have a right to recall some of their funds. So it's not a huge amount, but it is something that for us to be comfortable to go into a liquids that we'd want our group to do a little bit more analysis to make sure how much we can put into a liquid fund, for example, not just in case some type of emergency happened and the Superior Court or the LACERA fund actually called back cash, which I don't think would happen, but I think we have to plan for it and be prudent if we do go down this road.
Okay, thank you for that. But when we moved to a plan model a year or two ago, didn't we, or from an agent model, and didn't that allow us to develop separate investment plans, separate investment plans for each of the participants, each of the agent plans?
Chair Knox and Mr. Kelly, you are exactly correct. So the OPEB Master Trust is made up of 3 different plans below that. So yes, we would be able, for example, if we did do private equity as an example into Superior Court, we would be able to kind of divvy it up so we can match up those liquidity parameters.
Okay, and then at what asset size do you envision the OPEB trust, at least for the county, could just mirror the asset allocation for the retirement trust?
That, Chair Knox, I'm not sure if it would mirror exactly the asset allocation. I think that's something we would bring forward after the capital market assumptions are approved, hopefully next month. We would bring in different scenarios for the board to consider and then have discussions and then follow from your direction on which way to go.
Okay, I'm in support of generally expanding the asset classes into which the fund is invested. And then a question for Santos. Every year, there's a pot of money, and I can't remember what the technical name for it, but there's a pot of money that flows from the contributions the county makes, and it may be left. It may be the balance of unspent retiree healthcare money. So I can't remember, but there's a pot of money that is to be allocated over to the OPEB trust annually, and I wanted to make sure that is.
I'm sorry, I didn't hear that.
There's a pot of money every year, and I think it's a residual balance of unspent county funding for retiree healthcare. I can't remember exactly what it is, but there's a residual balance every year that by design, by agreement, is to be transferred from that other fund into OPEB trust. And I want to make sure that those transfers have taken place. You can follow up on it, but I'm just interested in making sure that's happening.
I'll have to follow up on it. I know that we had a discussion about those particular items as part of the premium negotiations, and I think there was some crediting back, if I remember correctly, but I'm not 100% positive if monies have been transferred over into the OPEB fund. So I will have to get back to you on that point.
That would be great, because there were in essence, there were the county contributions into the OPEB, there were the earnings on OPEB, and then there were these additional residual balances that were to be transferred. Those were the 3 sources of income I remember for the OPEB trust. So those are my questions. I'm so happy it's $2 billion. Thank you for the investment team for all that you've done and our colleagues at Makita. And I'm generally in support of expanding the investment options for the trust.
Thank you, Mr. Kelly. Mr. Festino, did you want to comment?
I was muted. I was going to elaborate on Mr. Kelly's observation with respect to liquidity or illiquidity. Each time a plan sponsor or a fund moves into illiquid assets or does it for the first time in this case, is very important. I would say it's prudent to at a minimum review it and document it, even if it appears there's no issues. Because once you go in, you cannot just get out as easily as you can from the other, stock and bond like portfolios. So you heard from Mr. Perez, likely some, follow-up and some confirmation that it's going to be okay. That is what we're leaning towards. We have reviewed, different actuarial reports and such. So we're fairly comfortable, but we just wanted to make sure that it is something that you keep in mind, that we documented, that is prudent process, essentially what has been done.
I appreciate that. Thank you.
Thank you very much for that. And Mr. Bernstein.
Thank you, Chair Knox. Great report, great results. I also remember when OPEB was just barely more than a glimmer in our eyes, and it's fantastic to see the progress. I have a question because I don't recall, and it's beyond the concerns about emergency takings of money from the OPEB. The fundamental idea of OPEB was that eventually it would help to offset costs. Is there an established trigger with the county on when they would start to pull money down? Is that sort of undefined? $2 billion is not insignificant, and it will get attention. I'm just wondering if we've established when that happens, if that's a conversation we're beginning to engage in, or when we think that conversation might get triggered.
Chair Knox and Mr. Bernstein, I think it's something we have to do more research on, especially if we do go down this road of incorporating a liquid assets into the asset allocation. I can get back to you with what the parameters are. I know from my standpoint, I don't know what that trigger is, but I think it's something that we have to investigate heavily if we go down this road, because the current status right now is everything passive. So if there was some type of drawback, it's easily enough for us to get liquidity and provide that. So it's to be determined is where I'll leave it.
I just think as great as it would be if we believed that it was going to go untouched in terms of maximizing return, we have to be realistic that this was a fund established for a purpose. We, staff in particular, has done a fantastic job of moving it towards purpose. At some point, somebody's going to notice that. I also think that just this general conversation is timely and welcome, and I look forward to it. Finally, I would ask of Santos that the Board of Retirement, although not responsible for the decisions about the asset allocation, will be understandably interested in the progress and this conversation. I would ask that updates be provided to the Board of Retirement effectively in real time. So even perhaps tomorrow, just an update that this is being talked about, so that the Board of Retirement trustees who do not also serve on the Board of Investments are prepared to answer any number of reasonable questions that may come their way.
We will make that adjustment.
Thank you.
Thank you, Mr. Bernstein. I had a comment, but before I did, I believe Mr. Granger is on the line and he can possibly answer Mr. Kelly's question from earlier.
Yes, thank you and good morning, Chair Knox. Just a follow up in terms of the court redemption that was referenced earlier. Yes, the court did request that LACERA pull money from its OPEB trust account to provide some ongoing contributions that were due for the healthcare program. So the money, just wanted to clarify that the money was not actually pulled out of the trust and given back to the court, but instead the funding was used to, in fact, fund court required contributions for their ongoing healthcare benefits, essentially the pay-go costs. And the court has only done that one time. That was sort of a one-time thing. As far as the custodial fund is concerned, as far as funding of the OPEB trust, there are two sources of funds, obviously the OPEB trust contributions and the investment earnings. The situation with regards to the custodial fund and pulling money from the RHC program to fund the trust, that situation occurred 2 times. And that was some discussions between the county and LACERA. And essentially the monies held in the RHC accounts, the operating accounts, are what we call the custodial fund. Those monies are analyzed by our RHC director. And again, those were discussions that the county and LACERA had.
So that is not a regular funding stream and cannot be relied upon from the county. Again, a two-time event. And finally, in terms of the county essentially, I guess the way I look at it as far as tapping into the OPEB trust to pay benefits, it's really at the discretion of the county in my view. And that probably might occur when the county has satisfied on an ongoing basis the actuarial determined contributions, or the ADC. And so the actuary does calculate those projections, and we expect that, and I can't remember off the top of my head, but I want to say it's about 23 to 25 years from now when the county's contributions will meet that minimum or sort of that ADC point. And at that point, I suspect that the county would request or direct LACERA to use OPEB trust funds to pay benefits. But again, my feeling or my belief is that it's really largely up to the county to go back and to request that we do that. So I just wanted to provide some color around those topics.
Mr. Kelly, you had a follow-up?
Yeah, thank you. Thank you, Ted. I appreciate the comments about the RHC, but monies, but my understanding is that that analysis was still done annually, even if the analysis did not identify any funds to be transferred over to the OPEB trust. You're suggesting otherwise, that the analysis was somewhat ad hoc.
Well, I'm not aware that the analysis is done annually, but that might be misinformation on my part.
Okay.
I do
fine.
know that
Santos,
that is monitored.
That's fine. Santos, if you could just take that as a takeaway. And then the other comment is, I think you're right. I think part of this conversation has to be engaging the county in terms of what their thoughts are on the use of the funds. I think you're right, Ted, that their original comments to kind of the working group of LACERA, treasurer, auditor, et cetera, was that their intent was to build up the pot of money to meet the requirement, which was in 2048 or something like that. It was far away, and then at that point they would potentially look to that pot of money to make the annual payment. So I think the county CEO needs to be engaged as part of the conversation about liquidity on an ongoing basis. Thank you for the follow-up, Ted. I appreciate it.
Sure. Thank you.
Thank you, Mr. Kelly. I don't have any other requests to ask questions here. I was just going to comment that I'm generally supportive as well. And I think, Mr. Grable, you mentioned this as part of the implementation as we move forward. I was just curious to know more about the potential costs and fees and whether that alters even the staffing model in your team, to address the differences in allocation going forward. So I look forward to that information. Okay, with that, I think that concludes this presentation. Now we're moving on to item B under reports, MSCI Analytics Investment Risk Education. Mr. Perez, I assume you're going to kick things off again before we hear from MSCI?
Yes, Chair Knox, I will.
Okay.
As you mentioned, the next item on the agenda is the MSCI Analytics Investment Risk Education. As the board will recall, at the January 2020 meeting, the board approved a recommendation to hire MSCI to provide total fund risk services. At that time, it was communicated to the trustees that the onboarding or the implementation process of such a system would take about 12 to 18 months. I can report that we are on schedule and the implementation phase of LACERA's total fund will be completed in the next couple of months. Because of where we are in the implementation process, we thought it would be a good time for MSCI to provide education to the board on their total fund analysis tools, as well as discuss the MSCI Analytics platform, their risk methodology approach, give an implementation update, and lastly, preview LACERA's total fund risk report. So with that background, I'll hand it over to Jorge Mina, MSCI's head of analytics and chair of MSCI's Executive Diversity Council, Stella Kondi-Jacos, Stella, I hope I pronounced that correctly, Executive Director of MSCI's Implementation Services, and Christopher Brady, LACERA's MSCI Risk Consultant.
Thank you very much, Mr. Perez.
Will you be advancing the slides?
Just a gentleman by the name of Chris Wagner will be advancing the slides. If you just cue him, he'll move them.
Perfect. I'll do so. Thank you very much. And I'd like to thank LACERA, first of all, for the opportunity to work with you on this project, and also for the opportunity to address the board today and tell them more about MSCI, the tools that we have, we're providing for LACERA, as well as give an update on the general implementation of the risk management infrastructure that we're putting in place for LACERA. So if we go to the next slide, Mr. Perez already introduced us. I'm just going to caveat with saying that I look about 20 years younger in that picture, but I'm Jorge Mina. I'm the head of analytics at MSCI. I have been with the company for about 22 years in a variety of roles, and I've been running the analytics product line since 2017. I'm based in New York, and my colleagues Stella Condonijakos and Chris Brady are both based in San Francisco and working directly with LACERA. Chris is a consultant dealing with day-to-day questions that come up on risk and performance, and then Stella is managing the implementation of the system. So if we move on to the next slide. Yeah, and so this is the agenda. I think we've gone through it. So next, please. Next one. Thank you. So just to tell you a little bit about MSCI, in case you're not familiar, we are a publicly traded company in the New York Stock Exchange. We are a investment decision tools providers, and our mission is to help investors build better portfolios for a better world. We have 4 product lines: indexes, analytics, which I represent, ESG, and real estate. And our goal is always to be the leader in each one of these areas, right? One thing that I will mention is we are a leader in providing ESG and climate information to financial markets. And as such, we take also corporate responsibility very seriously for ourselves. As Mr. Perez mentioned, I'm also the chair of the Executive Diversity Council at MSCI, and we have a Chief Responsibility Officer, Diana Teed, who also is a member of the executive committee, like myself, and runs our index business. So we have senior executives in roles related to corporate responsibility. And if you're more interested in what we're doing internally in terms of our own governance, we just released the SASB report that talks a lot about our diversity and inclusion practices, and also a TCFD report with some more elements on sustainability. We have carbon emission disclosures, and we have targets that we've set out for ourselves for the next several years. So if we move on to the next slide, please. So this is a little bit of who we work with, which, as you can see, we have a large footprint globally, over 1,200 clients using our risk management analytics across client segments. So we serve asset owners, we serve managers of assets, so hedge funds and asset managers, and we also help intermediaries such as banks and broker dealers. And I think very importantly for LACERA, we have a very deep penetration of top US public pensions. So a lot of your peers are also using our products. And this is important, not because we want to have lots of clients, but because these organizations tend to have very similar challenges. And so what we often do is, we leverage the collective knowledge and the problems that they're bringing to us that they need to deal with to improve our products, to always be at the leading edge, and to be able to provide a great level of service to all of them collectively. So that's why we are extremely excited to work with LACERA as part of that group of institutions that we work with. So if we move on to the next slide, please. Next. Great. So, one of the key things that we do for our clients is risk management. And, I don't need to explain you what risk is, but basically you can think of it as how much money we can lose in a given time period with a given likelihood, right? And that's interesting to know how much we can lose given our existing portfolio, but that's just measuring after the fact, which is important. But these tools are actually more interesting when you start from the beginning and you use it as a mechanism to discuss risk tolerance. How much risk are we willing to take? And if you're within that tolerance level, then great. But is it optimal, right? Could you be doing things better? And if you aren't, then what decisions do you need to make to bring it back to where you want to be? And this is where you start thinking risk not as a problem, but actually as a resource, almost as a currency, right? That you need to spend optimally to generate returns. If you don't take risk, you get risk-free rates, but that might not be enough to get to your objectives. So that's how risk budgeting gets into the concepts of asset allocation and manager selection, and understanding the drivers of risk and return and how much risk to allocate to each one of those drivers becomes very, very important, right? So if we move on to the next slide, factors are the language that we use to talk about drivers of risk and return, right? Factors are the characteristics that drive risk and return in a portfolio. So what are factors? Just to give you some simple examples. In the case of equities, it would be the size of the company, or the industry of the company, the country where the company operates or generates its revenues, whether the company is a value or growth company, the quality of the earnings, the momentum, and a number of things like that, right? In fixed income, it would be things like the duration of the portfolio or the average spread, et cetera, et cetera. And so what we have done in MSCI is basically spend a lot of time researching what are the drivers of risk and return across all asset classes, and then building models that capture those drivers. And then we can map a client portfolio onto that so that you can do all kinds of analysis on your portfolio. So if we move on to the next slide. So MAC here means multi-asset class, right? So the MSCI multi-asset class factor model is kind of behind everything we do. And there's a couple of points that are important here. The first thing is what does it mean that it's multi-asset class? Well, it means that is consistent and complete across all asset classes. We can cover every single asset in your portfolio, from equities, fixed income, various private assets, whether it's private equity or private real estate, et cetera, right? So you can model everything in your portfolio in a consistent way. The second thing is that it has multiple levels of granularity to support different investment decisions, right? Because, for example, in risk management, you need a lot of granularity to get to all the detail that you need to manage the risk of the portfolio. So at that level, you have lots of factors that you want to track and follow. Now, if you're looking at manager selection or ongoing monitoring of managers, you probably need fewer factors. There's less things that you want to keep track of at that level. And if you're doing asset allocation, then there's even fewer things that you want to track, right? And keep in your head as you're thinking about asset allocation. So our model has the ability to consistently, if you will, zoom in and zoom out to different levels of granularity to support a number of different investment decisions in the organization. So with that, let me pass it on to Chris, and he's going to talk a little bit more about what we do specifically in private markets. So over to you, Chris.
All right, thanks, Jorge, and thank you again to Chairman Knox and the board for allowing us to present to you today. And I think, and this has come up many times in this presentation already, I think we'd all agree that the growth in private assets investing is really reshaping the pension plan landscape, and that's obviously the case for LACERA. The traditional 60-40 mix of stocks and bonds has really given way to a 40-40-20 mix, really, of public assets and alternative investments in private equity, real estate, infrastructure, and hedge funds. Obviously, plans are attracted to private assets for their return potential. But what is often forgotten is that they create a huge challenge for risk management. The standard risk management technology, it was really designed primarily for publicly traded assets, and they're really not well adapted to the private asset landscape. I find in my experience that the organizations that we tend to work with, and that's MSCI, are very aware of this challenge and are seeking a way to sort of apply very rigorous risk management to every asset class, including privates. So you can advance the slide there. Great, thank you. So I think the most important question at this point is, how are private assets different from really a modeling standpoint? I think the most important difference are the returns. Private asset returns are derived from, quarterly appraisals. Transactions are few and far between. There's no daily transactions, which you typically see with, let's say, public assets, and those returns are also smooth. The challenge for a data modeler is to capture the unique characteristics of private assets, but also make them essentially compatible with public assets like, for example, an Apple or an Exxon. And I think, the term normalize is perhaps the right way to put it. MSCI has developed a way to do this by combining, private data from our partners, which is Burgess in this case, for private equity with public information. In this slide here, I have an example that shows you, basically how we combine public proxies. And in this case, we're looking at a traded healthcare stock, and we're combining, let's say, public information with pure private return information for a buyout strategy, as well as the specific return for the private equity investment itself. And we're able to combine those two, or rather three, sources of risk to come up with an estimate for, a risk estimate for this private equity investment. And I would say that, I'm talking about private equity here, but we're largely using the same approach for both private equity and real estate. And you can move the slide forward, please. There's what we see with all of our clients is very much a huge appetite for private equity right now, and that's especially in sort of rapidly developing regions like China and India. Any good model, and this goes for a private equity model as well, needs to be sufficiently comprehensive to capture the full investment universe. In our case, for MSCI's model, we cover 3 regions. So we cover North America, Asia, and Europe, and then we cover the 6 primary strategies across buyouts. So that's large buyouts, small buyouts, early and late venture, as well as distressed and mezzanine debt. So it is quite comprehensive. And as I previously mentioned, our model depends on Burgess data. So that's a partner of ours, and we believe that Burgess data is the deepest and perhaps the most dependable source of deal information in the world. So it's a really good starting point for our model. If you could advance the slide, okay. There's currently a tremendous amount of uncertainty about private real estate, especially sort of the headline news about office, retail, hotels, and I'd also say the same about certain regions in the United States. So some will potentially rebound very quickly, others it will take more time. So I think it's important that the private real estate model, just as we're doing with the private equity model, be detailed enough to capture the variation in returns between let's say a city like Dallas and Chicago, or offices, for example, and self-storage. The MSCI risk model is very detailed. It's based on core property type and region factors that you see, just on the left of the slide here. And we provide added level of detail with property subtypes and major metro areas. One other feature that I think is important to point out is the model is very responsive. So the public market proxy in both the real estate and private equity models is designed to reflect market regime shifts. So, obviously more responsive than traditional methods. And if you could just advance the slide again, right. I think it sometimes goes unnoticed, perhaps here in the United States, but MSCI is, in addition to everything that Jorge mentioned, is the leading provider of institutional real estate information in Canada, in Europe, and most of the rest of the world. We take full advantage of this in our risk model, and we currently have over 32 countries, including India, China, Indonesia, Brazil, and Mexico. So many of the developing markets that are going to be interesting to you in the future. Obviously, it's still unusual for U.S.-based plans to venture out of the domestic market, but I'm pretty sure that this will happen in the near future. So we're going to just jump over in this sort of next section here. If you could just advance the slide. We're just going to talk about the risk management system we're building actually for LACERA. And I'm going to hand it off to my colleague, Stella, who will give you an update on the implementation project that we're engaged with right now. Over to you, Stella.
Chris, thank you. Hello, everyone. It's good to be with you today. My name is Stella Candanijakos, and I work with the LACERA team and lead the implementation of our MSCI risk and performance solutions for LACERA. What you see presented is a high-level overview of our risk and performance solution implementation for the LACERA Total Plan and OPEB Master Trust. The plan is broken out by phase and identifying each of our delivery goals within each phase. Our delivery priorities, scope, and milestones were defined by value to LACERA, focusing on the delivery of risk insights for the Total Plan and OPEB Master Trust, with each additional phase enhancing the risk modeling and insights for each of these investment strategies. Today, we are delivering monthly risk reports in production for the Total Plan and OPEB Master Trust, which you'll see a little bit later on in their presentation. We're continuing to optimize data management, enhance position transparency for manager funds, and we're working on delivering multi-portfolio performance attribution. It has been a pleasure working with the LACERA team to implement our MSCI risk solutions, and I will pass it on back to Chris Brady to provide an overview of additional services MSCI provides for LACERA.
All right, thanks, Stella.
Thank you.
So, MSCI's risk management solutions, basically two ingredients. We've got the people and we have the tools. And I sort of tend to give a slight edge to the people in terms of their importance. We always start with our implementation teams, and that's what Stella is a part of. And so they're first on the ground. They typically provide very intensive development support for, about 6 to 12 months. And we're seeing that, as Jude mentioned, we're on track with that at this point. After the implementation is complete, operational support is transferred to our managed services team, who are primarily responsible for data management. Much of what they do is, highly automated, but they will engage, and they do engage with clients at least weekly, if not more frequently. Each client is assigned a dedicated analytics consultant, and that's my role here. The consultant will typically work very closely with the investment team and often stays connected with the account for many years. In my case, again, I've personally been engaged with one large client, pension client in the Bay Area rather, for about a decade. So it can be a relatively long relationship. In addition to the analytics consultant, we have a team of client support specialists who are available 24 hours a day in all the major market regions, who provide, on-demand support for all of our products. And, of course, behind the scenes, there are hundreds of researchers, developers, and product managers, throughout the world that are, working on the client experience. And so if you could advance the slide, excellent, thank you. So, obviously the risk management tools are, very important as well. I think Borrow One is, and Borrow One is the solution that LACERA is selected from MSCI. It really stands out in the institutional software marketplace as the most comprehensive solution for, sophisticated pension funds and endowments. In this slide here, just on the left-hand side, I've listed some of the really 6 most important tools that I think LACERA will take advantage of in the Borrow One solution. The first one is risk attribution. Attribution tells us, how much risk each asset class, sub-strategy, or manager is contributing into the plan's risk. Attribution will become more important as you potentially explore risk budgeting or risk targets in the future. And we'll see more of that later on in the presentation when I show you some of the reports that you'll be looking at. Manager selection is a very important component of our solution, and it crucially depends on our fundamental factor models. Factor models are fantastic tools for revealing a manager's true strategy and ensuring that they stay true to that mandate. We've also, supported clients who use these tools to evaluate managers, find managers that are, have, let's say, overlapping strategies, consolidate and essentially lower tools. So that's or rather lower fees. So that's, certainly an important feature. What if analysis, and this gets to basically asset allocation strategies and strategic asset allocation. What if analysis is really just prototyping for that type of work, so asset allocation. And I think it's going to become a very valuable tool whenever you're evaluating prospective changes to the policies, the plans, even in situations where you're considering adding, let's say, private assets. It's a way of analyzing what the impact would be of that change in the plan. I think stress testing is certainly going to become extremely important in the analysis that you do. It's becoming more important just lately, and we're certainly making quite a few investments in that area. It really allows investment teams to evaluate and prepare for future states of the world, such as economic recessions or other financial shocks that, and then measure the resilience of the plan's investments against those adverse conditions. 2 more items here that I think are worth pointing out. Asset liability analysis, that's something that you may at some future point be interested in incorporating. It really gives you the ability to analyze both your assets and your liabilities simultaneously, which can be very useful. And finally, I'll point out that Borrow One includes all of the simulation-based value risk approaches as well. So if you can advance the slide here. So in this final section of the presentation, I'd just like to give you perhaps a first look at some of the risk information and reports your team will be using and what we'll ultimately be sharing with you. If you could just advance the slide. Thank you. Yeah, sorry, just back one, apologies. So this first report provides a high-level overview of the plan's risk position and essentially the interaction of each of the asset classes. What you see on the left-hand side is essentially the total risk of the entire plan. In terms of how to interpret that number, just at a very high level, we can go into more details later on, but the higher the number, the higher the risk of the plan and the more exposed the plan is to large losses. We also calculate the total risk of the benchmark or the policy portfolio. So that's what you see underneath that. Active risk, which is the next sort of KPI that you see here, tells us how much the plan's returns can deviate from the benchmark. It's a forecast of tracking error, and it's a measure of the additional risk of the active investment decisions that you're making, either through allocation or selection. We also provide the beta and effective duration of the plan in this report as well. If you look to the right, it's essentially, the table there is a very straightforward example of what I just talked about, which is risk attribution. The ability to see, not just the plan's risk, but how each one of the asset classes is contributing to that risk. And then what you can also do is monitor that over time. So what you see here is the plan's risk is, in this case, 15.69%. And the table is telling us how much each one of those asset classes is contributing. And not a surprise, growth is definitely the main contributor here. If you can advance the slide, please. Thanks. This next report is what we call the risk, is also a risk attribution report. It's what we call our allocation selection report. It is focused, the previous report was really focused on what we call sort of total risk. This report is focused on active risk. So active risk comes from the differences between the portfolio and the benchmark. For example, if the plan increases the allocation to growth, this will create active risk. And so this is the decisions we're essentially going to be evaluating in this type of report. In addition to individual managers who are making active investment decisions that create what we call asset selection risk, there are allocation decisions that contribute. So we're basically breaking down the active risk into those two buckets: allocation decisions that you're making as part of your sort of strategic asset allocation or tactical allocation, and then the selection decisions that your managers are making. All right, and if you could just advance to the next slide. So factor analysis, this is something that just came up a few slides ago. Many of our clients at this point are interested in allocating to factors rather than traditional asset allocation groups like the asset classes. And they will incorporate that into their planning process. So rather than look at saying how much should we put in growth versus, let's say, liquidity, they will think in terms of these fundamental factors that we have. In many ways, and I think Jorge pointed to this earlier on, factors provide a much more precise means of targeting the true sources of risk and return. And so when you sort of start looking at your allocation to factors, this is the type of report that gives you that additional information. You'll note one thing here, the total risk is the same in both this factor-based approach as well as the previous approach. So really the only difference is we're attributing that risk to factors here as opposed to those asset classes. And just the final last sample report, there are many others, but we just sort of selected a few here. This shows the sensitivity of the plan to a set of historical and forward-looking market scenarios. Historical scenarios represent market conditions during significant financial events such as global financial crisis or the 1987 market crash. So, those are what we would call historical scenarios. We also incorporate forward-looking scenarios. So these are forecasts of potential market events such as, commodity price inflation or a trade war. So both of those types of scenarios are combined here. The bar graph on the left displays the scenarios where the plan has a positive P&L result, while on the right, the negative P&L scenarios. Stress testing really helps to uncover some of these, the embedded and often unseen vulnerabilities in the portfolio. And so I think it definitely will be a useful tool. And just if you could move that forward, the slide forward to the very last slide here that I have. So as I mentioned, these are just a sample. There are quite a few other reports that we have available. There's other mechanisms for reporting as well. Our goal at this point with this implementation is to provide a full report package for both, the plan, OPEB, report sets will include, total plan, asset class, sub-asset class. So all the way down to, individual managers and portfolios, and, a quite complete set of content in each one. And the delivery plan at this point is I think we're planning to get these reports to you by June of this year, and we'll also include at that point a training session so that you're able to interpret the information that we're providing to you. And I will leave it there.
Thank you very much for the presentation. Very informative. Mr. Grable, anything to add before we open it up? I don't have anyone in the queue at this time.
No, I'm really excited. This has been a project that we've been working on for a long time, and it's really easy to focus on returns. I think, once again, the quality of returns and how we position the portfolio through the uncertainty that we discussed earlier is really that will help us really excel over the decades to come. So I'm really excited about this.
Okay. Thank you, Mr. Grable.
All right, thank you.
You're welcome. Thank you. And that will bring us up to the report items for information only. And just a time check. I know we're about 2 hours in. I was planning on about a 10-minute break before the executive session. But items C through H are for information only. I have not received the request from any trustee. Mr. Santos, did you have a question on one of the items?
Yes, thank you very much. Let me just coordinate it here real quick.
Sure.
This is for Mr. Grable regarding AC, the
executive order.
Right, the executive order. Sorry.
That's all right.
Mr. Grable, I read your report, and actually it was Ted Wright who produced the report. And my question is, while we have been in discussions with our managers regarding this particular executive order, have we incurred losses, costs associated with that? Number one, and number two, I'm not quite sure with, and I realized that I'm the one who raised that issue months ago when the executive order was announced, but maybe this is a legal question to our attorneys. Does this really apply to a level to the municipalities like the LA County? So those are the two questions that I have. I am concerned that we are forced to incur expenses that otherwise would not be required to do.
Mr. Grable, did you want to weigh in?
Yeah, Ted, did you want to answer? If not, I'm happy to answer. This is something that we're working not just with our managers, because much of our exposure is indexed or is in factors. So we're working with the custody bank, and whatever rules are put in place, be it an OFAC list or whatnot, it's something that it's pretty inexpensive in order to implement. It's maybe the cost that's being referenced is more one of an opportunity cost to the extent there are portfolio gains or not gains. But this is something that we certainly are working with the custody bank and will put in place whatever rules are imposed upon us. And as it relates to the legality of that, I'll certainly defer to Steve Rice to see if he has a comment. Otherwise, it's something that we can addressed through a subsequent memorandum.
Yes, it would be best to address this. I can't give a definitive answer today on this.
Okay. Thank you. Is that it, Mr. Santos?
Yes, sir.
Okay.
Thank you.
Thank you. Any other questions, comments on items C through H? Hearing none, seeing none. We are on to items for staff review. Linda, do we have any items for staff review?
Yes, I have 3 items. So the first item is the board requested for staff to include all LACERA recruitments on the CEO report. The board requested for staff to bring back the status of the CEO, CIO, and chief counsel evaluations and salary adjustments. And the board requested for staff to provide confirmation of status of the OPEB trust contribution sources and to provide update on the OPEB trust allocation to the Board of Retirement.
Okay, thank you. On to good of the order. Linda, can you please call on the trustees?
Absolutely. I will start off with Mr. Oakham.
Yes, I have nothing this morning. Thank you.
Thank you, Mr. Oakham. Mr. Kelly?
Thank you for a really good corporate governance chat this morning. I really enjoyed it.
Thank you, Mr. Kelly. Ms. Greenwood?
I don't have anything today. Hope everybody's doing well.
Thank you. Mr. Bernstein?
Nothing from me at this time, but good to be with everyone.
Thank you. Ms. Sanchez?
Nothing.
Thank you. Mr. Santos?
Yes, thank you. I'd like to thank all my colleagues for your kind words. And thank you, Mr. Knox, for your wonderful card. I really appreciate it. This is in connection with the death of my brother. So thank you very much.
You're welcome, Mr. Santos. And I was just going to add that with your permission, we would do like the Board of Retirement did and adjourn in the memory of your brother at the conclusion of this meeting.
Thank you, sir.
Thank you. Mr. Kehoe?
I have nothing. Thank you.
Thank you, Mr. Kehoe. Mr. Green?
I also want to add, sorry for your loss, Herman, loss of your brother, and send my condolences from everybody in my family. I also want to appreciate and support and recognize the comments that were made in the public comment this morning, right before the meeting. And was thinking how much the folks that spoke this morning that trust us with their pensions, our retirement security, and their future literally depends on the decisions that we make as a board. And so I think as a trustee, I'm always committed and always thinking about how we promote our investment strategy to get the highest possible rate of return and protect our members' assets. But I also think it's important to listen to their voices and most importantly, listen to their values. So this June 2nd will be my 21st year as a LA County employee. And as a elected LACERA board member, I believe that the investments that LACERA makes and the vendors that it chooses to manage, we should support the interests of the workers who place their trust in LACERA, or at the very least not work against their interests. So recently I signed on to a letter urging BlackRock to follow its policies and discontinue PAC donations to federal legislators who continue to refuse to accept the results of the 2020 election. And like a lot of people, I was disgusted to see our nation's capital under attack on January 6th and the anti-Semitic, racist and divisive attacks on our democracy. When Donald Trump called on states to stop counting the votes after he learned he was losing, the United States Chamber of Commerce, which is the largest business lobbying group in the country, joined with organizations like the AFL-CIO, faith leaders, to demand that every vote be counted. Shortly afterwards, the Business Roundtable, the National Association of Manufacturers, the National Association of Wholesalers and Retailers all issued similar statements. And since the election, hundreds of largely public traded corporations have stopped contributions to federal legislators who refuse to accept the legal, legitimate results of the November presidential election. So I just wanted to say I stand by my statement and I will absolutely not apologize for supporting democratic institutions. I will not apologize for the peaceful transfer of power, supporting the Constitution, because I feel that these values are not just good for workers, they're good for business, and they're good for LACERA. So thank you.
Thank you, Mr. Green. Mr. Knox?
I'd like to thank staff, obviously, for their efforts in preparing for the meeting today. I thought it was very good. We spoke earlier about OPEB, and I wanted to mention this month's unsung hero. We'd like to recognize Tara Elijah for the work she does on the OPEB Trust. Your efforts are very much appreciated, especially given the potential shifts in asset allocation we discussed earlier. The other item was I've been talking to Mr. Grable about the fact that we're doing these virtual meetings, and I missed some of the informal touch points we would have with investment staff when we meet in person. So we thought we'd try something new where we do a virtual coffee. Each of the trustees will have an opportunity to meet with a different team in the investment office, private equity, real estate, et cetera. We need to be mindful of Brown Act issues, obviously. So these will be more focused on relationship building and educational focus. We can't get into an agenda review or discuss specific past or future items or pending board matters. So it's not mandatory, but we thought we'd give it a try once, get some feedback from each of you, and then we can expand where there's an interest. So John will be sending out an email with the particulars and ground rules, which may ask that you submit maybe in priority order your 2 or 3 groups that you would prefer to meet with, and we'll do our best to line folks up with their top priority. So with that, I thank you all.
I'm just going to call on Santos Cramen.
Nothing for me. Thank you.
Okay. John Grable.
Hopefully some of those votes for those virtual coffees are with the Office of the CIO. First, we have to create the Office of the CIO. But one of my favorite things to always announce are new people in the team. And I will, if he can turn on his camera, we're joined today by our newest intern, Noah Fritz. Noah joins us. He's being sponsored by Sponsors for Educational Opportunity, SEO, pardon me, and the PRIA Foundation, which is the Pension Real Estate Association. Noah is currently a junior at the University of Michigan. I know we have a trustee in Mr. Oakham who is from Michigan, but Noah had another internship with another public pension plan in the past with New York State teachers, and hopefully he'll learn definitively that LACERA is the best looking public pension plan in the United States, or maybe the world, bar none. But we're really excited to have Noah on board and working with the real estate team for a while.
John, if Noah's on board, all I'll say to him is go blue.
Yes, sir. Go blue. Thank you guys for having me. I'm looking forward to getting to know all of you over the course of my internship.
Welcome.
And lastly, Steve Rice.
Good morning again. Nothing from me.
Okay, thank you.
Okay, that's everyone. Linda, why don't we take a 10-minute break and meet back at 11:45? And Linda, you'll help clear those in attendance that are not part of the executive session.
Absolutely. I'll take care of that right now.
Thank you.
Thank you.